Welcome to Subramani. Sorry. Today the government of India made some changes in taxation. I'm not even talking about the increase in SGT on F&O. But debt fund taxation has changed a bit. Changed a bit in the sense you invested in a debt fund, you got a chance to pay capital gains tax, and you could choose to pay capital gains tax after a few years. So you could postpone the tax, that of course, and you could pay at a lower rate. Assuming you got 7% return and 6% was the indexation, and on that 10% tax, so which means you paid literally no tax, right? Even after you held for 8 years, 9 years, 10 years. So there was a huge tax arbitrage available to you vis-a-vis a bank fixed deposit. So suppose you put money in a mutual fund and the mutual fund put money in a bank, which means it is the same asset, you got a better treatment than what you would have got by going to the bank. Similarly, you bought GSEC. If you bought GSEC directly, you were taking no risk, but you were paying 40% tax. I'm assuming at the highest slab, 40% including the surcharge, etc., maybe even higher than 40% slab, more than 40% tax. So that was a little unfair because the same asset class was being taxed differently in different hands, right? So if you bought a gilt fund, you could pay literally no tax, maybe 10% tax after indexation. And so indexation was, let's say you got 7% in gilt and got 6% indexation. So you literally paid no tax. But the direct gilt fund, you paid 40% tax. Same thing for a AAA or whatever. So the wrapper in which you bought decided how much tax you would pay. Even for a minute, assuming that endowment plans were also debt funds, right? Largely endowment plans were debt funds. On that, the yield would be much lesser because there would be an element of insurance deducted, and you would get a bad return, but the whole thing would be tax free. You invest in through a mutual fund, you would pay almost zero tax because thanks to indexation and a 10% rate. In fact, it was better than even equity tax if you held for 20-30 years, because in equity there is no indexation. We do not know how the whole thing is going to pan out, but this is the position now. If you bought through anybody else, I mean, so if you had an AIF, could an AIF launch a debt AIF? Answer is no, because you would be taxed at 40% slab. Could you launch a debt PMS? Answer is no, because that would again be hit by a 40% tax. So if I went to a client and said, why don't you put in this? So if I told a client, why don't you put in this AIF, he would say, oh no, it will be 40% tax. Why would I not put through a mutual fund and pay zero tax, right? So the tax arbitrage is gone. Secondly, when you talk of debt funds, you talk also of gold funds, you talk of foreign funds. So which means the government of India was almost incentivizing you by charging you lesser tax, even when you invested abroad. Whether you invested in Taiwan, China, Singapore, didn't matter which shares you were buying, but you were paying lesser tax. You were paying almost no tax if you got a good indexation. So that has gone. So the arbitrage taxation arbitrage has gone, but remember, only the taxation rate arbitrage has gone. The taxation time arbitrage still stays. So if you invest at the age of 30 in a debt mutual fund and withdraw at the age of 65, instead of paying tax at the age of 30, you will pay tax at the age of 65, assuming that your rate has not changed. If you withdraw at 75 and your rate has changed, you still have an advantage. So that some of those advantages stay, like investing for a minor and withdrawing when the minor has no income, right? Or when the minor becomes a major at 18 to 23, 24, when they're studying, they would have no income. So that is the time when you could withdraw, right? So some of those arbitrages are available, but the rate arbitrage is gone, right? So whether you're an AIF or a PMS or a mutual fund or you're a direct investor, that is all that has happened. Now going to the bad things. The RBI allows you to go direct and invest in GSEC, and they also give you an indicative yield, which the mutual fund industry is not supposed to give. But the RBI gives you that, say, this is the yield which you will get on a 10-year bond or 11-year bond or a 12-year bond, and that is a rate. There is no risk in that, right? Because this is gilt. So you can go directly to the RBI site and buy. I personally don't, because I don't like I would still like the tax time arbitrage, right? gold was being taxed differently at different rate, right? In a debt fund or in a mutual fund, gold was taxed at a lesser rate, whereas when you bought gold, you were charged at a higher rate. So again, gold mutual funds or versus direct gold versus SGB. Right now, SGB comes as the boss; it beats the others hollow, right? So here you have the tax arbitrage is gone, so the mutual funds will crib, but the AIF and PMS should be happy. If you are an individual, you now have more options of where to buy. One good thing which could be a fallout, I still don't trust our regulators too much. Our debt market could develop very well. Right now we have no debt market. All mutual funds were doing was buy AAA. And they knew that because of the tax arbitrage, people had to come there, right? So I am a director of Tata Sons. Can I buy Tata Sons bonds? Yes. So should I buy it? No, sir. Please buy it through Tata Mutual Fund. One good thing which will happen is the debt market will today have your AIF, your PMS, direct people, and of course the PFs, etc. who are there. So everybody coming into the market means the market will deepen. You will not only have AAA chasers like the mutual funds where you will have somebody picking up AA plus, somebody picking A minus. Somebody would say you want 10% yield, here is a good debenture to buy. You want to take the risk, you take it, and the risk will get priced in the market. It won't be like the equity market. All the players, whether somebody is buying 100 shares or 1 million shares, everybody comes to the same market. So there is fantastic price discovery now with the increased number of players. There would be better price discovery, more bonds would get listed. I think the next move by the government, by the RBI should say anybody who requires more than 5,000-6,000 crores of bank funds cannot come to the bank, they have to go to the bond market. That's the way to deepen the bond market. I do not really know whether that is the plan of the government, but yes, this is a good move from the market point of view, in the sense that there will be deepening of the market, but the mutual fund industry is going to crib about it, saying, oh, we had this nice easy to low hanging fruit with which we were having fun, that's gone. But the mutual fund industry, they have also the finance ministry also said any fund with at least 35% in equity will still be taxed as a debt fund. So there you will get capital gain. So the message is very clear. If you take risk and you invest in Indian securities, you will get some tax benefit. But all this is gone for the foreign funds. So what should you do as an individual? Just chop your SIP and STP into foreign funds. Wait for some time and see what is happening. By this one stroke, I think the government has also saved some dollars, right? So all the money which was going into SIP and STP of funds in whichever part of the world, China, Taiwan, US, that will stop. And that's a good thing for the government. Maybe the dollar will start weakening against the rupee. I'm just guessing. This is all not what the finance minister said, right? So a lot of lesser quality bonds will get traded, more number of players will be there, which is a very good thing. Tax postponement is still possible. The wrapper taxation, like the same asset, because the wrapper was different, it was being taxed differently, that is gone. So whether it is an insurance company with a premium above 5 lakhs, or whether it is a debt fund, or whether it is buying directly, all of them would be taxed at a particular rate. So I'm sure banks did not like the fact that there was such an arbitrage available. The insurance companies did not like the fact that they were being taxed. So some kind of a pressure. I don't think it is too bad the way the mutual fund industry will make it out to be. There will be more funds with 35% equity. I mean, there will be some balance advantage kind of funds which will have at least 35% in equity, 35 to 65 in equity. So the taxation could be either a equity taxation if it is above 65% or a debt taxation, but definitely not a taxation as current income, right, which happens for all other funds. So your ultra short bond fund, your liquid fund, and all those things will now be taxed at full rates, which is not too bad, because anyway it was going to be taxed at a higher rate, simply because the withdrawal from these funds was anyway not taking 3 years. Nobody would keep in the liquid fund for 3 years. They would keep it for 3 months, right? Ultra short bond fund for maybe 5 months, not 3 years. So anyway you were paying similar tax. So it's not really too bad. And still your pension plans, etc., with 35% in equity and 65% in debt continue to get taxed the same way. I'll make better videos. This is a very quick one which has been made. Tomorrow we are hearing from other fund managers Once I hear all that, maybe I'll improve, I'll give you better stuff. Thank you.